Great to be here. Jesus set me up for the transition between kind of the micro thinking about the causes of fertility and what's going to happen to future fertility. I want to talk about the macro consequences. So in this paper, we're going to think about three outcomes. We're going to think about implications for interest rates. We're going to think about implications for asset accumulation or wealth, and then implications for fiscal sustainability. Right? Our motivation is these trends, these macro trends that macroeconomists have widely documented, which are falling rates of return on wealth and rising wealth to GDP ratios or asset to GDP ratios. And in the paper, we want to think about this not just through the lens of demographics, but more broadly, we want to say what are the key drivers of these evolutions. Demographics has been widely cited as one of the drivers. There's also things like productivity, inequality, the global savings glut, automation, market power, and so on. So we want to try to write down a framework for thinking about how all of these forces are interacting and also what they might do in the future. Right? And there is kind of a literature that addresses these questions with sort of fully specified macro models. And the approach we're having in the paper is a little different. We want to sort of think about all of these things as basically, we want to think of the two things that I showed you earlier as like a price and a quantity. And then we want to write down a framework where there is a supply and a demand curve. And then drivers like demographics are shifting the curves. They're and we'll write down a framework like this, and then we'll derive in that framework sufficient statistics for the extent to which things like demographics are shifting out the demand curve for assets, say, right? So the goal is to be pretty transparent about what drives these things. So in these models that we'll write down, you can do simple calculations that are based on just cross-sectional data, basically. You look at, say, the population distribution, you look at the age profile, and then you say, hey, let me forecast how the aggregates will evolve just based on the evolution of the age structure of the population, given the behavior that we observe in cross-sectional data. And that's going to give us the shifters of asset demand and supply. And what we'll find when we do this, I'll go relatively quickly over this because that's not so much the topic of this conference, but kind of looking backwards, we'll find that this asset demand has surged ahead of asset supply. So that explaining why we're seeing this increase in wealth at the same time as we're seeing declines in interest rates, and that demographics is a key driver of this, right? So that basically the fact that people have wanted to save more or just wanted to accumulate more assets has led to this surge in asset accumulation at the same time as the returns have fallen. And then we want to take this on to think about the implications for the future of demographic change for long-run fiscal sustainability. And so here, when you think about fiscal sustainability and demographics, there's always kind of the obvious public pension point, right? Which is, well, that as demographic change, as we have more and more old people, we have this rising cost of public provision, of pensions, and also of health, and that's just making debt more unsustainable, right? But at the same time, because of the thing I just told you, because demographics is just driving this big desire in wealth accumulation and declines in returns, you kind of have this offsetting force, which is that an older population demands more assets, and so you can, to some extent, finance your increased health expenditures by just issuing more debt, right? And so there's so this is why we conceptualize this, as this is the title of the paper, as a race between supply and demand. And specifically for the future, we'll think about demographics driving this race between the increase in the supply of government debt that's driven by all these expenditures that you're not financing by, say, increasing taxes. Instead, you're just issuing debt to pay for them. And at the same time, there's rising demand for your debt. So to some extent, you can do this. And so interest rates are not rising too quickly because actually there is a lot of demand for the extra debt that you're issuing. And so we'll think of this as a race, and we'll think about the next 75 years through this lens, right? And so we can do a calculation that just says, given the patterns that we observe in the data of how much asset accumulation there is at each age and the forecasted population distribution in the future, where will the demand for debt be in 2100? And we'll get a number like 80 to 150% more of GDP in asset demand, right? So this just says, holding interest rates constant, this is how much more debt the population would want, right? But at the same time, we'll have very quickly rising supply in the US because of this huge fiscal gap, right? And so there it's like you just forecast how much expenditures there will be on things like Social Security and Medicare and Medicaid, just assume that the taxes are not rising. And so you just have this fiscal gap and it just keeps increasing. And so that just keeps, and that's the problem is you're comparing a stock here with like a flow here, because the flow keeps rising. And so the stock gets enormous, right? And so, eventually, of course, this is unsustainable, right? So eventually you have to address your debt problem. And so the key question for who wins the race isn't so much, at status quo, clearly the fiscal situation in the US is unsustainable, but the question is, when will they start addressing it? And so we'll have, it depends on when this fiscal gap is addressed. But what we argue is that because of this force here, the debt to GDP ratio could rise to a number like 250% without interest rates rising, but that will require a big fiscal adjustment. Okay, so this paper we wrote for Jackson Hole, and people were like, "Wow, this is super dovish paper," because it says debt to GDP ratio could rise a ton. It's like, but it's also a super hawkish paper because it just says the tax rate to GDP ratio will have to rise by like 12% or something like this, right? So we'll have these two numbers, and we think they're kind of interesting, just as like an implication of just thinking about demographics for the fiscal future. Okay, so what I'm going to do is present this framework basically, which is just thinking about asset market equilibrium and thinking about how demographics is shifting these curves as well as these other forces. And then I'll show you how in this framework you can have this sufficient statistic way of quantifying the things like the impact of demographics on shifts in asset demand and supply curves. And then I'll have some section on measuring past shifts in asset supply and demand, where I'll try to convince you that demographics was like a big force there. And then we'll talk about these projections. Okay?
Just to make sure I understand, you're going to assume that people in the future are going to save in the same way as they have saved in the past?
Yeah, and that'll be an implication of the model. Yeah.
But then if they're in this fiscal adjustment, they're going to live in a different world where the state is going to pay lower pension, so they are going to probably make different decisions.
That's right. Yeah. So I'll say relative to like their post-tax income, they'll behave in the same way. But yeah, if you start increasing taxes, then people will cut down on things. Yeah. So taxes will shift these curves as well. Yeah. So I'll start doing calculations where I say, well, assume you hold the tax rates constant, assume you hold interest rates constant, and you just have demographic change, what would you get? And then we'll say, well, now there needs to be an adjustment. So if adjustment is through taxation, how does that change these calculations? Yeah.
So to get demand for different type of assets, you can have convenience yields or something?
Yeah. So here I'm just going to want to think about an overall stock of total assets, and then I need to then confront the fact that the returns are different on different types of assets. So I'll do this via convenience yield, so I don't have to think about aggregate risk or something like that. Yeah. So specifically, this is a framework for thinking about total quantities of assets, right? So nothing specific about government debt. It's just government debt is one of these assets, right? And so you see it over here. This is this asset supply function, right? It's like if there's debt, there's capital, and then there is profit, the capitalized value of profits. And so that's how we'll think about the supply of assets. So and they're all lumped into this one big kind of total amount of assets that the market is supplying, right? And that's for people to hold it eventually. So we'll have this asset demand. There's a domestic asset demand, which is your households are holding eventually, like there's a bunch of intermediation and so on. But at the end of the day, the households are holding these assets as well as foreigners, right? So minus the NFA is just the amount of your domestic assets that are held by foreigners. Right? And so we have these two curves, right? So here you see this point about the return, right? So in this framework, there's just one return, and we'll think of this as the average return on total wealth, so which is some weighted average of the risk-free and the risky rate. And the way we'll think about asset supply is completely standard. So it's like a sort of neoclassical model with some rents and things like this. So we won't really innovate much on this. This is completely standard macro. And where we'll be spending a lot of our time is thinking about asset demand. And so the way we want to think about these asset prices and quantities is just well, the interest rate is the rate that equilibrates the market for assets, right? So it's the price that clears the market. Okay, so that's kind of how you can visualize this. So on the x-axis is the wealth to GDP ratio, on the y-axis is interest rate. The asset supply curve slopes downward, so that's classic. You know, one of these forces is, say, as interest rates go up, you know, the user cost of capital goes up, and so firms want less capital. So there's these classic forces that make the asset supply curve slope downward, right? And so and here, because we have the capitalized value of profits, you also have the value of these assets. So you have rents, and then those rents get capitalized into some asset values, right? So overall, think of asset supply as the total value of assets issued by firms and the government, given the market R relative to GDP, that slopes downwards. And on the other side, you have asset demand. It's the amount of wealth that households and foreigners want to accumulate in the long run, given the market interest rate that they see, right? And that, in our framework, the key thing is that it's upward sloping, right? And so that differs from standard macro theories. So kind of classic macro theories would have this be perfectly elastic at the given interest rate, right? And so the key is going to be that we depart from that by having some finite elasticity with respect to the interest rate. And so we're going to use an overlapping generations model to generate this elasticity, right? So if you have an upward sloping asset demand curve and a downward sloping asset supply curve, then kind of you can start thinking about all these forces as acting through this diagram, right? So think about forces that raise asset supply are things like more government debt, obviously, or automation or rising capital intensity are going to lead firms to want more capital in the long run. So that'll push out the asset supply curve. Rising markups, by creating kind of pressure on valuations, so just making there's more profits out there, that'll raise the asset supply, or higher expected growth, which again via valuations, by raising valuations, will push out asset supply. So if all these forces dominate, you see R star rises. And on the other side, you have shifters of asset demand, so things like population aging. So as I'll show you, you know, there's this kind of strong force where as population ages, you're going to get more total demand for assets just because you have more old people that have a lot of assets. Inequality can be a force that acts like this in our model. It'll sort of push out asset demand, lower expected growth, lower taxes that we're talking about. That's a shifter on the curves. Less generous social security, right? Because if you make social security less generous, then people have to save more for their retirement. So that'll push out asset demand. Or rising foreign asset demand, right? And so if all these forces dominate, then R star falls, right? So the race is between these two things. It's like, well, which one will win, right? And in particular, for the future, we'll be thinking about this rising demand from population aging versus the rising supply for more issuance of debt. Okay, so the first part of the paper, we just look back and we say, hey,
the model of asset demand is like homothetic? Or
it's a homothetic model in post-tax incomes. Yeah. Except for
there's like strong evidence for whether or not that assumption is.
Well, I guess it's homothetic over time. So it's like, you know,
because in the base, it's not homothetic. Right?
Yeah. And then we have this thing where we have inequality. So we'll actually have like across people, we'll have more assets held by the rich, right? But then the main thing that scales over time, like everything scales over time in after-tax wages or something. I don't know what the evidence is for that, right? But that's kind of natural to do in a model. So we'll do that. And also that'll help us think about what happens if there's a tax adjustment.
When you shift supply and government debt, you don't have those Ricardian forces that makes the demand shift at the same time because of the tax liability induced.
Right. So here I'm just saying, suppose that you shift that. Yeah. How can you do this, right? So in the simplest way, so this is related, right, to the discussion, but it's like, so here I'm saying, I want to consider the tax liability rising as like an independent shifter of the demand curve, but think that you could
so the government
issue, well, suppose that at the margin, what adjusts is G, right? It's government spending, right? And so you're not taxing households, right? So you're just issuing the debt, and then all your adjustment on your government budget constraint, you're doing at the margin on the G, so that way you can shift the supply curve without shifting the demand curve, right? And otherwise there is, like, these households are not Ricardian, that's for sure, but still they pay attention to taxes, right? And so if you're adjusting tax rates, then you'll be shifting the demand curve. Right? So if you're taxing people more, then there's less demand for the debt.
How should we feel like inflation this year? You think inflation is going to lower the real value of the debt?
Yeah, I think of here inflation as more like a transition phenomenon. So I want you to think, one of the things we do in this paper is we're not going to think about transitions. So we'll just imagine that we're at the steady state, right? So inflation might say transitional inflation, like unexpected inflation, might say lower the assets, create capital gains for people. There's all these transitional effects. Here, I want to think of these curves as like neutral to inflation in the long run, right? Over here, we have just the real interest rate, and there's like a Fisher equation, and it doesn't really matter what the inflation rate is for any of these curves. They wouldn't be shifted by inflation. Okay. So for the next exercise, I am actually going to assume, and of course, this is a very strong assumption, but just it simplifies my life to do it this way. I'm going to just assume that at every point in time, we're actually at a steady state, right? And so I'll just go back to the graph that I showed you earlier, which was over time, and I'm just going to do this by plotting wealth against the average return. And so this is the data, right, where we started kind of over here, and we're now over there. What you can see is it kind of looks like it's tracing out some curve, right? And so what I'm going to say is like, let's assume that we know the semi-elasticities of these two curves. And I'm just going to take these numbers that are going to come out of my structural model in a minute, just to show you how I'm going to go about extracting these shifters, right? So I'll say there's kind of an asset supply curve, which flips down like this, and asset demand curve flips up like this. And then if I want to identify shifts in demand and supply, like a very simple thing I can do is just, I'm assuming that these elasticities are constant. And then I just take any point and I say, let's say this is 1950. Now I say, well, what happened between then and today? And the main thing you can see is like, it looks like we're just kind of going down that supply curve. And so it looks like there's just big shifts in asset demand that are moving us around, and the supply isn't shifting so much, right? So as an example, you take 2024, right? We're over here. So it's almost as if we were along this curve. The asset supply has shifted just a little bit, and then demand has shifted by a ton, right? So that's in between 2 years, right? And then you can do this and repeat for every year. And when you do this calculation, what's not surprising is, well, because we saw big increases in assets and big declines in interest rates, is that you must conclude that asset demand has risen way above asset supply, right? And so this is kind of at a point in time. You might not really believe these numbers. Like I said, they rely on you thinking you're at a steady state at each point in time. But I think it's very clear if you just look at the past, the past history, like you'll always be led to think like asset demand has massively risen above supply because we've had very big declines in interest rates at the same time as wealth has risen. Yeah.
But it's not going to come down to whether you think R minus G is the relevant thing to put on the vertical axis, because R minus G hasn't changed that much.
Yeah, so I mean, for me, it's like I'm gonna think about G as a shifter too, right? And so I'll show you my asset supply schedule in a minute, but it has some terms in R and some terms in R minus G. Yeah.
Right,
Yeah.
but the dots,
Yeah.
you're calling them steady states. You're only letting in total wealth in the R move, but other things are moving at the same time, like G.
That's right. That's right. And so the G to me, the way I'll think of it is like G just shifts this asset supply curve, right? And so G, like anytime G moves, it's a shifter of this asset supply curve. And I can actually measure that because at any point in time, I can just look at how much G moves. And so what I'll do, right? So here, this is just super reduced form, right? I'm just saying, let me just think about what happened to supply and demand over time, just to make the point that demand has clearly risen a lot relative to supply.
Why doesn't G also move the asset demand?
It does move both, yeah.
Okay.
Yeah. G moves supply a lot because of the effect that Andy's talking about.
I'm just trying to reconcile our claim.
Yeah.
Is that move in asset values is coming almost entirely from cash flows?
From the G movements.
No,
Oh.
from the fraction of output that is going to owners of firms.
Right.
And it has almost nothing to do with movements in R. And somehow I have to get from your picture to our picture, and I'm struggling with that.
Okay, well, let's talk about it. Let me show you one graph that I think is consistent with what you're saying, which is my decomposition of supply. So The next thing I'm going to do, so this is just to extract sort of baseline shifts. And now I want to decompose these things into different categories. And so one of these will be demographics, and one of these will be rents. So we'll see surging rents as actually kind of accounting for a lot of this. Right? Now we go back to 1950. So let me get there in a minute. Okay. So so my framework is going to be this. So general equilibrium overlapping generations model, completely standard asset supply. So I think this is similar to what you have in your paper. And what we're going to use the model for is to derive the sufficient statistics for asset demand. And then asset supply is just basically going to be a standard functional form. So we will, so let me just show it to you now, right? So we have, like I said, we have government debt as part of supply. Then we've got capital as a part of supply. And so this is Cobb-Douglas coming out of Cobb-Douglas production. There's the capital share alpha. There's some markup mu. This is the user cost of capital. And where taxes show up in there. And then there is the value of corporations, right? So this is 1 minus 1 over mu. This is the present discounted value of the rents they're making. And so here you see the G show up, right? Because of this capitalization effect, right? And so this is just our explicit function for asset supply. So we have these three terms. Note when we're discounting here, we're going to discount, we're going to discount K. And we're going to discount rents at this risky return, the higher return, and then we'll think about the rate paid on debt as the low rate, and then R is just the overall. Right, and so that's just our asset supply curve, and so it's kind of shifted by all these things, including the G, including movements in the risk premia, including movements in D over Y, which we can take from the data. And so with that, we can just do some basic accounting. We can say we see asset supply shift by how much we saw, how much of it is due to all these different forces. And then when it comes out from asset demand, and I was talking to Pauline yesterday, and she's like, "Oh wow, people have seen your paper, and there's all these equations." So it's like, just be careful. Not everybody wants to see too many equations. So I was like, okay, I'll just fit in. I'll just have this one thing. Speaking just for yourself. And but I just want to show you the basic. Model that we use is just this overlapping generations model that has sort of relatively standard features. So we have annuities and non-annuitized wealth. So people can save in both. They have this kind of regular wealth here, and then they have annuitized wealth over there. There's mortality risk. There's a warm globe bequest motive. So one of the things that I'll explain why people have high wealth in old age is because they just want to save, they have these bequests. We have age varying time preference for spending. So this is a little bit unusual, but that's because we're trying to exactly fit the age profile at each age. So what we'll say is we'll just have these age varying shifters of marginal utility that just justify why people have the wealth that they have, given everything else at each age. We have this explicit utility of holding risk-free bonds. That's just to get the liquidity premium. And then to think about inequality, the non-homotheticity will have these different permanent types that have different preferences and income levels, so that we can explain why the rich have more assets relative to income than the poor.
So how come you're born with 0 assets? Does that matter? I thought there's bequests.
Yeah, so here, because this is because we're trying to derive sufficient statistics, right? So if you have bequests being distributed to the young, then that just creates like the model becomes too complicated to deal with.
You throw a party at the end.
Yeah. So here, what you do is you give your children a bequest, and then they consume it immediately when they receive the bequest, or you just have a party at the end where you, like you said, or maybe you just spend a lot in your last year because that's in 3 months before you die is when you have all these health expenditures. So we don't have but we would model that as like a bequest motive. And in the paper with Hannes, our earlier paper, once we add the bequest, we have these complications where we actually have to keep track of the whole wealth distribution and bequest distribution. We have to model when people receive the bequest at each age. That matters for wealth accumulation. And so it's possible to do in a kind of a model like Zillow would write, right? But here we're gonna use this model to derive these sufficient statistics. So we kind of want to kill these
And
things
what
that
are
we
the
create.
indexing, the permanent types?
Yeah, the permanent text, I don't have it. I've suppressed the notation over here. There's like this theta. It's gonna come up in a bit, but yeah. So I think of all of this stuff as dependent on theta, basically. So the beta, actually, all we need is the beta, your beta j, and your kappa j. That depends on your theta. Okay, and so we're gonna use this setup to derive sufficient statistics. So I'm not gonna kind of bore you with the math here. I'm just gonna kind of explain the basic intuition of this, right? So, and the idea is you can use this shift chart type of calculations in this model to calculate the impact on aggregate asset demand from a shift in the age distribution, right? And so what's that? So this is where we're trying to forecast. Remember, everything is relative to GDP, right? So we're trying to forecast assets relative to GDP. And what happens as demographics is shifting, right? And so basically there is like a numerator effect and there's a denominator effect. The denominator effect, which is the effect on GDP from a shift in the age distribution, that's well known from, say, the demographic dividend literature, right? So this is just saying, let me take and we'll think of every age as being substitutable in production. There's an efficiency, there's a relative efficiency you have at a different age. So what that means is if you want to just forecast what will happen to GDP in the future, you need to forecast what's happening to effective labor supply. And so for that, we can just look at what's the income that people make at different ages. And we say, well, let's look at the income distribution where it is, what the age distribution was over here today, where is it forecasted to be in our scenario, which we take UN, we take some weighted average between the UN medium and low fertility projections. We have this age distribution that's forecasted in the future. And so what happens to GDP is, well, we just have a lot fewer people that are prime age, and we have a lot more people that are already retired or they're not working. And so that's pushing down on the Y, right? And so the shift chart calculation gives you the right quantitative magnitude for the effect on GDP in the simple model. And then what about assets? Well, that's the same calculation, but done over the asset, the age asset profile, right? And so this is what I was saying earlier is the age asset profile has this property where, contrary to, say, the standard Modigliani life cycle hypothesis, people don't really decumulate assets, right? So they ramp up their assets between age 40 and 60, and then assets stay at this really high level. And so as the population ages, you just have a lot more and more old people, right? And so you have all these 80-year-olds, and these 80-year-olds have like $1 million of balance in their 401k, and they're really not drawing that down so much. And so you just have all this, this rising demand for assets, right? And it just keeps going.
I know your model's not gonna distinguish this, but in the data, do we know like what all this stuff is? Is it just like they're sitting in houses that have become really expensive? Like what are the kind of assets of the elderly?
Right. So, I mean, for the model, what matters is that this here, like for this calculation to be valid, is that the profile, the cross-sectional profile that you observe is actually the result of some ex ante optimization decision that people made with, and you could explain this in the model with either, preferences for late in life spending, or you could explain this with bequests, but it's like a decision they made.
So I get that it doesn't matter for the model. I
No.
just want to know if we know and we are what.
Well, but one thing you mentioned, which I think is kind of potentially important to explain this, is that it's possible that this is just not a decision. This is actually just valuation. So people just bought a house, and they got really lucky, and now they just have this big house, and they're not selling their house, right? And so if so, that's not something that you would expect to be repeated for future calls, right? So I'm just saying, if you think that a lot of elevated wealth in old ages is just kind of a time effect, right? And they're just people who got lucky, then this calculation can't work because it's just assuming stability of the life cycle decision problem.
That's the topic of an opinion video in the New York Times, either yesterday morning or this morning, blaming my generation of boomers for riding an escalator up.
Right.
So you could, that's articulation.
Right, that's right. And so, I mean, I think, there's reasons to be concerned about that for the US, but, you look at these age wealth profiles across countries where the timing of the housing boom is very different and so on. And it's kind of a pattern you see everywhere, right? And so there is a literature that explains why there's limited asset accumulation in old ages. So, and again, there'll be country specific factors like in in the US, old age expenses are really, really high for health and things like that. So that's sustaining, high wealth in old ages. But so, yeah, so for the model, it matters whether it's a time effect or just the result of a decision. But then within decisions, it doesn't really matter. And there is a literature that tries to say, how much of this is bequest motive. Maria Cristina Denardi has worked on that, for instance. Like how much of this is, late in life expenses, and there's a debate. So for this model here, it's like just doesn't matter, provided that it was something that they wanted to do.
And the fact that you ignore the bequest, how does it, I mean, you say there's a lot of wealth at end of life.
Yeah.
So it sounds like there's a lot of bequests.
Yes.
There's a lot of bequests, so what do you
Sounds
do
like
with
it's
them,
just an
right?
assumption.
So actually one thing there, and we did, so in our earlier paper with Hannes and Matt, we look at this in the context of a structural model. So for structural models, if you want to think about how demographics interact with bequest motives, you really, really want to ask yourself whether people have a bequest motive in terms of total bequests they want to give, or whether it's a bequest motive per child. And that matters a lot for both reasons. So if it's a total number, you have fewer children now. So if it's just number of bequests per child, you have to save less to give your bequests. But this and so that's one force, right? If it's total bequest, then there's fewer children. So then children, when they receive the bequest, they receive more. And so that affects asset accumulation. And so these forces, you can quantify them in like a simulated model, right? So here we don't have these forces, so we don't have to simulate the model. But yeah, if you think about bequest motives, I think that's a very important one, which is just what's your.
Would you have done this figure for the US, but going back like 30 years or something to see if it's stable over time?
Yeah, so the stability, so the age wealth profile is actually, if you normalize it by GDP or something like that, is actually quite stable, right? It's not perfectly stable, but it actually is quite. And so, yeah, so you can redo this calculation based on, all of the SCFs going back to, there's actually this SCF plus, you can go back to the 1950s, and the patterns are very similar, right? The overall numbers they vary. For the number I'm going to give you is something like 30%, maybe, depending on the year in which you do this. But it's kind of, yeah. So which is another indication that these, that this housing boom kind of effect on the wealth of the baby boomers is maybe, it's probably there a bit, but it's not the dominant story. Okay, so that's for demographics. We do the same kind of calculation for inequality. So again, for inequality, you can kind of you do a similar calculation where you can say, okay, well, the rich have higher wealth to income ratios, and there's rising inequality. So we now have more, the high income types have higher wealth to income ratios, right? And then there's more income inequality. So now as income inequality shifts, we have more income in the hands of the high income types, or the higher the quantities of the income distribution. And so that's going to shift total asset demand because of this reason. And so you can do a shift share type of calculation where you say, let me just predict wealth to income based on, say, young in life income. And then you look at the movements in the income distribution, and you can do a similar calculation based on just a shift share that gives you like a total amount in any given year, given the movements in the income shares, what's asset demand in that year just due to inequality. Okay, and so just to summarize, well, this is kind of a big framework, but just to think about all of these different forces that we're interested in, right? On the asset supply side, we have all of these things that are basically functional form assumptions. And then on the asset demand side, we are able to quantify the effect of demographics, of inequality. Productivity growth is actually a similar calculation to demographics. It's kind of like an effective shift in the age distribution due to the cohort effect on productivity. And then we have to, so when we want to think about things like social security or the semi-elasticity of asset demand, which is just how people respond to changes in the perceived generosity of social security or to changes in interest rates, there we actually have to do more involved calculations because we have to use the model more, right? So we have to say, oh, there's these life cycle sources. So if I cut income in old ages, how much will they respond in terms of asset accumulation? So this is a little bit more complex, but we have sufficient statistics formulas for that too. Okay, so given this, we're gonna use this model to think about the past first, and then I want to think about the future. Okay, so how much time do I have?
Like maybe 10 to 15 minutes.
10 to 15 minutes. Okay, so
15 is generous.
okay. So let me go relatively quickly because I want to talk about demographics more. So on asset supply, so we decompose these drivers, right? And so we have, especially since the 1990s, this relative and this question, right? We have this initial decline in asset supply that's due to the slowdown in growth, and then since the 1980s, we have a big increase, and that's mostly due to rising profitability. So I think this is how it connects to your work. For asset demand, so we were able to do this calculation where we say, well, okay, the age distribution of population has evolved, income inequality has evolved. How much did that contribute to asset demand, right? So remember, we have this big increase in asset demand, and a lot of that is demographics, right? So we also have inequality and slowing productivity contributing, but demographics is like a big component over here. So that's kind of our analysis of the past, right? So now we say, let's just think about the future. And there's lots of things we can't forecast here, like what will happen to productivity, right? But one thing we can forecast relatively well, I mean, modulo the caveats that Jesus brought up about UN is, the future demographic evolution. So we're actually going to take a weighted average of the low and the medium fertility scenarios from the UN projections to forecast the age distribution of the population. And we'll use this for two things. We'll say, well, first, how will asset demand evolve? Right, so that's the demand side. And then we'll also say, how will expenditures on things like Social Security and Medicare evolve based on just constant generosity, but using the forecast changes in the age distribution, right? Okay, so if you do this, you see demographics keep pushing up asset demand, right? So, and by kind of a big number, right? Like something like 220 points of GDP, just from the continuing aging of the population with all these, additional 80-year-olds that have all these really high balances.
Just to be clear, this is coming from the observed relationship that old people have high wealth
Yes.
Income.
100%. Yeah, we're fixing at 2016 the age profile, and then we're saying
there's no deep theory of why old people like to save so much. It's just...
No, it's in the betas and the it's like there's all these shifters in the bottom.
To give you that.
Yeah, we have a model that can fit it exactly
Okay.
as a result of a life cycle decision problem. And so then we say holding these parameters fixed as we keep moving through the age distribution, like. All of this is compositional effects, right? This is just coming from the age distribution is shifting, and old people have more assets. And that's the forecast. Yes.
But this is holding taxes at the.
Holding taxes at the current level.
Otherwise, the green will shrink.
Exactly. The green will shrink. Yeah, I'm going to show you this in a minute. Yeah.
Is it monotonic or is there massive saving at the end of life? I mean, you don't have requests in the model, so.
No, there is bequest in the model. Yeah. And like I showed you, there is a little bit of a decumulation, right? There's a little bit of decumulation from 60 to 100, right? But it's kind of tiny relative to this huge ramp up from 30 to 60. Right? So this is all, basically you could think of this as there's many fewer 30 to 60-year-olds and a lot more 60 plus, but and these guys have way less assets than these guys.
That's because it's a level, right? At some point, the saving toward the end of life will affect it.
No, because I mean, it's too small, like, it depends a little bit on the population projection you use, right? But it's kind of flattening out, right? It's basically as we get to stationary population, it is monotonic. It kind of keeps rising. It doesn't stop. It stops. It stabilizes. It doesn't decline.
Sorry, Adrien. So how should we think about this thing where these guys are saving for to give these big bequests, and then the bequests kind of disappear from the resource constraint of the next generation?
They're eaten up, yeah.
Right, but like you would think that if these guys have like a target, the next generation have a target level wealth income, when they get this giant bequest, then they should start running it down.
It's possible, yeah. So if you think that the thing that's happening is that there's fewer kids, so they get like these bigger and bigger bequests. At some point, you have such bequests, you want to run it down. Like in the earlier paper, we were looking at the ages at which people get their bequests. It's typically kind of old anyway. It's like 50 plus, right? So then you're already you've already accumulated a lot of assets, and so it's not really that meaningful because you get bequests too late in life for this to matter.
Factual demand before you're ready to get.
That's right. So then you have to forecast the age at which you'll get a bequest. So then there's like a lot of uncertainty over when you'll get it, and so you can start baking that into the model, like precautionary.
Age 20, you know what because you're gonna get. Your parents are, 50 or whatever, you live in a nice house someplace.
No, but you don't know when they are going to kick the bucket. That's the real answer.
Okay, so let me move forward because I know time is running a little short. So we have this shift chart calculation for demand, and then we have shift chart calculation for supply. So the way we do this is we'll say, let's just look at age dependent spending on Social Security, Medicare, and Medicaid, and then let's roll forward the age distribution of the population. And so what you see is this giant increases in both programs, right? So this is at constant generosity. This is actually not so far. These are the CBO projections, right? So we're basically in the middle of the CBO projection. So, it's a relatively mechanical calculation. And these numbers are ginormous, right? If you think about the sum of the two, it's like 10 plus 9% of GDP. So that's already above the total tax to GDP ratio in the US today, forecasted to be in 2100. And so this is our forecast for the primary deficit, holding everything else fixed. It's like, if we don't do anything, this is what will happen to the primary deficit. It will balloon to a number like 12, okay? And so then we do this calculation, and then we say, okay, every single year, this adds to the debt. And so this is the asset supply that's forecasted, right? Holding things fixed. So it's like, if we don't do a fiscal adjustment, the race between asset supply and demand is totally won by supply because one process is stationary and the other one is not, which is that unless you do a fiscal adjustment, you'll just keep having a debt to GDP ratio that rises. And these numbers are enormous by 2100. Right?
And this is extra.
This is in addition to the 100 and
what we have.
yeah, exactly. It's so it's like a 600 and something percent of GDP
If the
ratio.
labor share recovered,
Yeah,
you're gonna have a big countervailing drop in asset supply.
Right. So I'll get there if I have time. I can show you. I have these scenarios at the end. Okay. So the basic thing we do is we say, without a fiscal adjustment, debt increases by 500% of GDP, while the demand for debt only increases by 300%. Right. So then you say, okay, well, obviously you need to have a tax adjustment, but if you do the tax adjustment and you don't load it on the G, you actually, you do a fiscal adjustment, which is not just cutting spending, you actually raise taxes, that will lower asset demand. And so this line over here says, holding interest rates constant, what could be the debt to GDP ratio that you could sustain once you do the fiscal adjustment? And so this is a number like 150 in addition to today. So this is our 250% of GDP number, right? And so this kind of looks kind of dovish, I guess, but we compare at the end our calculations to what's happened in Japan, and it's not that crazy.
What about tax revenue divided by GDP in Japan?
Yeah, so I'll show you that at the end if we have time. And so basically that's kind of this calculation, but it does require raising tax revenue by 12% of GDP, which is this big number, and that's just because these entitlement programs are growing, right? And so in the minute I have or something, we address a bunch of questions. This was really a big concern for the
3 minutes, so don't worry. Minimum 3 minutes.
Oh, minimum of 3 minutes. Okay, so one thing I want to address first is like, is it realistic that tax revenue will rise by this much? And then I'll talk about things like AI or labor share, things like that, automation. Okay, so let me show you this graph, okay, which kind of really I thought was super striking when we did it. Okay, so this is tax revenue to GDP. It's like 17% since 1950. It's basically been completely constant. There's been a bunch of tax reforms and so on, but in total, the US government basically brings in 17% of GDP in taxes. And then if you say, okay, how was that made up? It's like in the 50s, it was basically defense with tiny entitlement programs. And what we've seen is a big decline in defense and a huge increase in entitlements. And we're now at 11% of GDP, and this is the forecast, right? So this tells you, so this is like, if you hold generosity constant, you obviously can't have defense go way down by more. There's also other, right? And so you say, okay, if we're already here at say 20, then add the other rest of government, and, you know, it's kind of, I think, inevitable that the tax to GDP ratio rises substantially. Right. Okay, so what about like these what if scenarios, right? So we have this simple graph in the paper where we say we can use this model to think about a bunch of alternative scenarios, like what could help this, what could mitigate. And so our basic graph is going to be as a function of when you decide to stabilize, like say when you decide, obviously, you know, it's going to take a little while before we do this big fiscal adjustment, but as a function of the debt to GDP ratio in the year in which you decide to get your act in order, what will be the risk-free rate that you face? The longer you wait, the higher the rate. And what's the fiscal adjustment you need to do, right? So a number like 12. And then how is that affected by different forces, right? So things like, well, what if markups rise, right? So what if if markups rise,
I want them to fall.
yeah, so you want them to fall. So you could take this line, which is rising markups. So rising markups, what it does is it crowds, it's raising interest rates, which makes it harder for the government to sustain the debt, right? So if you think that competition or something, competition legislation or something will be able to bring the markups down, then that helps you a lot because then you lower asset supply, and so you have more space for the government to issue its debt. And you can think about things like raising the retirement age, right, or lowering generosity of Social Security. That actually helps you a lot because you have less to pay in pensions, and you make people save more for their retirement, which increases the demand for your debts, right? And so those things are kind of factors that go in the direction of helping with your problem. But no matter what, you have this huge fiscal adjustment to do, right? It's just kind of slightly less. It's like a 6% of GDP as opposed to a 12% of GDP. And you still have this demographic really helping you. And so, I mean, I think it's fair to say that it's likely, we'll likely live with debt to GDP ratios that are much, much, much higher than what we've ever seen, like more like what's in Japan, because, we're going to keep doing this for a little while until the financial markets wake up, right? And so just to conclude, Jesus actually was showing this comparison with Japan, and so I'm going to do the same thing. So this is just thinking about, what's happened in the past in terms of, so this is the old age dependency ratio against old age benefits in the US. This is the history of the US. This is our forecast. This is what's happened in Japan, right? So you kind of see that we're sort of tracking what's happening to Japan pretty well. And then this is, debt to GDP ratios. So just to show you that actually, usually what happens when you spend more on, public provision of pensions is for a while, you just issue more debt. You don't adjust the taxes, and you see that, this is kind of history of the US. This is what happened to Japan. And so I think it's fairly plausible that, yeah, you could just keep doing this for a while because you have all these old people that just buy your debt. And so
So Japan has kind of stabilized this debt to GDP ratio despite having these problems.
Yeah.
And my understanding was it's done through financial repression to some extent rather than taxation.
Yeah. Yeah, we don't have much to say about that directly. I mean, I guess it's a form of taxation. Yeah. But yes, we don't. We do look at like alternative ways you could finance it in the context of the model. But yeah, our baseline is like we adjust the tax rate. I think the US definitely by international standards have like a lot of room to adjust taxes.
And the taxes you have are what, labor income taxes or
they're both on labor and capital.
I mean, like the same incidence.
Yeah, it's a constant tax rate. It's an overall tax rate on labor.
No, like labor taxes are way better, I guess.
Yeah, I mean, here the capital taxes are distortionary, and so yeah, actually the labor tax shrinks your asset demand by in proportion. We could look at like what if you did some differential on labor tax versus capital.
Okay.
Okay, thanks.